They tell you it's a level playing field.
Nancy
System of
Pelosi
laws, not men. They tell you they work major fast, but behind the marble columns and closed doors in Washington, D.C., some of our most powerful politicians.
Her portfolio has surged by a staggering 745%. That dwarfs the SP's 242%, and even Warren Buffett's Berkshire Hathaway can't keep up. And well, she's not alone in this. Members of Congress routinely demolish the benchmarks. Now, flash forward to 2024, and David Rouser tops the list with triple-digit returns. In 2023, Brian Higgins rockets up 239%, while the S&P just limps along at 25%. If we look back to 2022, the pattern holds. Massive outperformance year after year. Search the data. It's right there, glaring at us. These aren't just lucky picks. It's an edge, sharp and honestly pretty unfair. Institutions might dump billions into the market, but Congress? They seem to time it perfectly, selling right as the peaks loom. The story really starts to unfold here. It's a web of insider knowledge where the laws lag behind and the profits just soar. You can almost feel the tension, can't you? The average investor bleeds while they, feast. But what stocks are actually fueling this fire? We're about to pull back the curtain next. Breathe easy. Knowledge arms you. We've mapped the blueprint. Congress sells amid overvaluation, mirroring institutions. Key? Spot the themes. Tech giants, pharma plays, payment titans, chip behemoths. They dump where bubbles swell, locking in gains before the pop. Your move? Analyze the data we uncover. Track congressional filings, compare to institutional flows. If they sell, question why. This isn't fear-mongering, it's empowerment. We've crunched numbers on 4 massive dumps, each a lesson in timing. Implement this. Build your watch list around their moves, but invert it. Buy where they undervalue. The solution clicks. Turn their edge into yours. Excitement builds. The first stock revelation hits now. Boom! Congress unloads Broadcom, the AI darling, roaring 84% in the last year, 32% year to date, and a staggering 2,649% over 10 years. It outperforms the S&P wildly, trading near all-time highs at $317. Wall Street screams strong buy, seeking alpha echoes buy, but valuations forward. PE at 42 towers over the 5-year average of 18. Yield dips to 0.77%, below the 2.8% norm. Institutions own 76%, yet they sell $45 billion while buying $253 billion net bullish in Q2. Congress, pure dump mode. Growth shines. B, plus rating 34% year-on-year, 28% projected, faster than sector and 5-year averages. EPS, 23% versus 15 to 16%. Double-digit growth ahead, but forward PE drops to 37.2 if targets hit. So, our intrinsic price? Well, it's $258. Meaning you're actually paying a 19% premium today. Wall Street targets $36, which leaves you with, honestly, zero upside, and the discounted cash flow sits at 22.4%. If you bake in 25% growth, you get $367, but that's still a 20% premium. Even if you settle for a middle ground of 20% growth, you're still looking at a 20% overpay. Is this the top? Congress seems to think so. They're fleeing. Your gut twists and you can't help but wonder what's next in their escape. Let's dive a bit deeper. Eli Lilly crashes into view, down 25% last year and 9% year to date. Yet it's up 730% over 10 years, absolutely crushing the S&P. Right now it's trading near its 52-week lows after its weight loss pill flopped analyst expectations. Insiders are loading up, 7 of them buying right at the bottom. There's a double buy signal from both Seeking Alpha and Wall Street. The forward price-to-earnings ratio at 26 undercuts the 5-year average of 38, and the yield is 0.9% compared to 1.2%. Over the last 5 years, it's rarely dipped this low, at least until 2025. Growth? Well, let's take a closer look. We're talking about an A-plus powerhouse here, 37% year-on-year and 29% forward growth. That's above the sector, and honestly, it's faster than the 5-year average. EPS is up 32% compared to 11% for the sector and 22% historically. There's a triple-digit projection for next quarter, a 50% track record and a recent beat. Forward price-to-earnings ratio is now at 23.1. Institutions holding 83% ownership have sold $90 billion, but they've bought $150 billion. However, in the second quarter, there were some heavy dumps, which, well, align with Congress. Intrinsic value sits at $691 with a minimal 2% premium. Wall Street's target is $938, that's a 33% upside. Baked-in growth stands at 35.3%. The drama really intensifies here. A pharma giant stumbles, Congress steps in to bail them out, but, you know, the metrics are practically screaming for a rebound. Feel the pull? Resolution approaches, but, you know, more twists await. Here's your edge. Eli Lilly really exemplifies it. When Congress dumps amid dips, valuations often signal buys. The solution? Layer growth projections over intrinsics. For Lilly, 35% growth bakes in upside, pushed to 40% for a 27% safety margin. So, here's what you want to do. Scan for A-plus growth in those beaten-down names, and, well, always cross-check institutional buys, even when it seems like everyone else is selling. Congress's exit? That could just be your entry point. Now balance the tension, pair your moves with insider buys, just like Lilly's 7. This isn't guesswork, not at all, it's data-driven dominance. Exhale the fear and inhale opportunity. But remember, the sell-off still rages on. Every next stock only heightens the stakes. So, Visa's stable coin storm, right? The company has managed to electrify the scene, weathering stablecoin threats with surprising resilience. They're up 29% over the last year and 9% so far this year. Now, the 10-year outperformance, it's a bit milder, but, well, it's steady. Currently, Visa is trading in the upper end of its 52-week range, even after taking a marginal hit. Both Seeking Alpha and Wall Street have issued double buy ratings. The forward price-to-earnings ratio and yield are hugging their 5-year averages, so honestly, the vibes are pretty reasonable. The blue tunnel, as they say, confirms it. Visa has maintained a consistent fair value over the last 12 months, with a few undervalued pockets showing up over the past 5 years. Growth has been steady, 11% last year, and that's expected to continue, which is above the sector's 7% and matches Visa's own historical pace. Earnings per share grew 13% compared to the sector's 10%, though it's a bit below Visa's own 16% average. All green quarters are expected ahead, and the forward price-to-earnings ratio sits just under 27.7. Institutions holding 82% sold $41 billion worth of shares, but bought $65 billion. So in the second quarter, institutional buys actually doubled sells, bucking the trend of Congress's persistent dumps. So, Visa's intrinsic value sits at around $350 with a 2% margin of safety. Wall Street, meanwhile, has it pegged at $405, which suggests an 18% upside. That price already bakes in about 12% growth. But if we look at 14% growth, as Wall Street seems to imply, then there's a 15% margin of safety. Honestly, if you're looking for a real bargain, you might want to push for a 20% margin and wait to buy at around $322. Congress just keeps selling, quarter after quarter, so why are they ignoring all this stablecoin noise? Tension is really building here. And well, the final dump pretty much reveals everything. ASML, the king of chip equipment, continues to dump shares amid this persistent earnings gloom. There's just no guarantee of growth in 2026. Let's see here. Down 20% last year, up 7% year to date, and a whopping 764% over 10 years, SP crushed. Currently it's trading on the lower end of its 52-week range. Now here's something quite rare. A triple buy across the boards. Moving on to undervaluation. ASML is experiencing a double undervaluation with a forward PE of 27 compared to 33. The yield is at 1%, which is spot on compared to 0.84. As for cyclical growth, it holds a C rating with 26% last year and a 10% projection, above the sector average, though below its own 16.4%. Earnings per share grew by 17%, compared to 15% for the sector, though that's still below the 5-year average. There are 2 growth quarters ahead, and the company is on track for 100% with a huge recent beat. Looking forward to 2026, the forward price-to-earnings ratio is under 25. Institutions, holding about 26%, were net sellers both last year and in the second quarter. The intrinsic value stands at $99, offering a 19% margin of safety. Wall Street has a target of $880, which implies a 19% upside even after recent target reductions. So, let's break it down. Baked-in growth at 9.1%. If we're looking at 10%, that's a 6% safety margin. A 15% buy comes in at $671, and a real bargain shows up if it drops 25% under $600. Congress dumps relentlessly. Are we just looking at cyclical fears here? The story really peaks with this. There's an elite flight from the very core of tech, leaving bargains scattered in the rubble. As the dust settles, remember this: markets, they climb walls of worry, but Congress's mass dumps, Broadcom's overvalued spike, Lilly's undervalued rebound, Visa's steady sale, and ASML's cyclical bargain, well, they paint a pretty vivid warning. They've outperformed for years, cashing out billions while, retail investors are still chasing. Yet in their wake, opportunities gleam for the vigilant. Hooked by those market highs, we watch as the elite quietly sell. And it's in those moments that undervaluations are revealed. The real climax, though, comes in the safety margins, where the prudent find their footing. You've journeyed through tension, armed with present-tense immediacy, active dynamism, concrete billions dumped, emotional highs of fear and hope. This isn't just investing, it's survival in the attention economy. What will you do? Follow the herd or seize the edge? Drop your thoughts below. Buy Lilly, avoid Broadcom. The market never sleeps, neither should you. See you in the next revolution.